Okay, morning everybody. Welcome back to day 2 of the 3Ws event here, live from Chicago, Illinois. And we're here at Maggiano's again, downtown. Very historic building. The likes of Frank Sinatra and others have been here. There's lots of pictures on the wall in the main bar. And we had a great day yesterday. Lots of information was imparted to everybody, and I think it would be fair to say, from the emails I've received from all of you, you think it was like drinking out of a fire hydrant. And today's going to be no better, I'm afraid. There's a lot more information to come. But the good news is David and I have agreed to do a live trading webinar on Tuesday. We're going to invite you all to it, and we're going to put VSA and the Weiss Wave together. I'll be trading my live account, so I'll be trading real money. It's a $5,000 account. So we'll be looking for trades. David's going to come over to my place, and we'll just sit there in my office upstairs, my trading office. Hopefully he won't forget his laptop like he did last time he came to my house, which was when he got out the taxi. And the one thing he'd said to me the night before was, "Well, Gavin, see this laptop? I'm going to lock it to my hand. My wife told me she'd kill me if I lose this laptop." As he walked through my front door and the taxi left, he took one look and went, "Where's the laptop?" It was in the back of the cab, or the front of the cab. Luckily, credit to Chicago cab drivers, within 15 minutes, wasn't it, 20 minutes? We had it back. Good omen for the weekend. So there we go. But David, where's your laptop? Right there. Okay, good. Keep an eye on it. All right, everyone. So what we're going to do now is hand over to David Weiss. Don't give the key to Steve, said Mark. Yes, we also have Steve here, Steve Phillips, who locked himself out of his house. So yes, that's a group of people we have as your educators here today. You've got no hope of making money in the markets with this. All right, everyone. Let's get underway, and I'm going to hand you over now to David Weiss. And there's two parts to this presentation. Basically, he's going to finish yesterday's, and then we're going to go to the second section, which you've all got in your PowerPoint slides. So, warm welcome, please, for David Weiss.
Okay. Yeah, it's pretty comfortable.
How's that?
It's fine with me.
Can you do a sound check for the internet? Just ask the internet. No, in this mic here. Just say testing.
Testing, testing. Can everybody hear me?
What's they saying, Steve?
Can they hear me? Yeah. Excellent.
Okay, good. And when you want to move the slide forward, it's the same as yesterday.
Yeah. All right, okay. Great.
All right.
Thank you. Well, to follow up on the story that Gavin just told you about the cab driver and how things evolve in this world, this morning, Gary and I got in a cab, and it was the same guy. No. I did. Yep. He said, "Don't leave your computer in here again." Yeah. Really. Absolute truth. I don't know. I don't know if that happens all the time here in Chicago. Well, I figure there are a few. Yeah, I felt quite at home. Well, anyway, it just shows what a good day this is going to be. All right. Let's see. A few things I wanted to say. I have met so many people who are seeking this or seeking that, particularly trades. And it reminds me of one of my favorite novels, which is Siddhartha by Hermann Hesse. And in that novel, there are two men who grow up together and then become monks of a sort and seeking higher consciousness and subjecting themselves to all kinds of deprivation. And eventually they go their separate ways. One becomes a follower of Buddha, and the other decides to live in a world of sensations, gambling, women, drinking, and he became very rich. And then one day he decided that he'd had enough, and he left, just picked up and left, went to a river and met another man and became a ferryman, pushing a little raft across the river. And he did this for many years. And one day his old friend came to go across the river, and he had heard that there was a very, very, very wise man, or seemingly a wise man, a man who seemed greatly at peace with himself, and he wanted to see him. So that he gets on the raft, and he says, "Sir, can you tell me what you found in life?" He says, "I've been searching all these years." And of course, this is Siddhartha's childhood friend, the man that he wandered in the jungle with for years. And Siddhartha says, "Well, perhaps you seek too much. You need to find." And I thought that was such a great statement, to find trades rather than to seek trades. In other words, if you just sit and wait during the day, and you don't sit on the edge of your chair with bated breath and your hand on the mouse looking for trades. Something wrong?
No, it's okay. I'm just reducing this. That's okay.
Oh yeah, right. Good. Anyway, I thought it was an appropriate lesson. Another thing I wanted to mention, one of the people that I've read fairly well, a couple of his books, is the psychologist Mark Douglas. I don't know if any of you have read his works or not, but particularly he wrote a book called Trading in the Zone. And in there, he talks about trading, and he says, number one, that trading is a probabilistic endeavor. It's in an environment where probability reigns, not certainty. He says, number two, anything can happen. And that's certainly true. You know, everything's going nice, and all of a sudden you come in one morning and one country's defaulted on its sovereign debt, or some other terrible thing has happened to affect the markets, whatever. And lastly, no one knows what's going to happen. And that's true too. If you can accept those conditions, the probability environment, the fact that anything can happen and that no one knows what's going to happen, and still work at this, you can endure and prosper in this game. All right, another thing I wanted to mention, I said yesterday that I've taught a lot of traders how to find trades. And I think that the Weiss wave is a real shortcut to learning to find trades. In other words, it is Wyckoff related, but it speeds up the learning curve a great deal. All right, with that all said, let's look at the first chart. This is a chart of the Canadian dollar not too long ago. And here again, I'm using one of these tick bar charts in which everything is scrunched up so that you really can't read the individual bars. This is a 50 tick bar chart. The Canadian dollar does not have the level of activity that the S&P has, or a lot of other markets too. And the volume on here is in hundreds of contracts. So when you see, for example, an up wave here with the number 18, that means there was 1,800 contracts on that wave, and so on. And looking at this chart, I know that all of you have looked ahead and you've seen all the charts already. When I set this up, I envisioned that no one would have, and that we could do this sort of in a quasi-real-time manner, watching it unfold frame by frame. Not wave by wave exactly, or inch by inch on the chart. Well, looking at this chart, what stands out? Is there a change in behavior on this chart at the top here? Anyone want to, what? Yeah. Is there a change in behavior? Does anyone see anything? What do you see, Paul? Not enough volume. All right. 21 and then 7. Okay. All right. Anything else? Well, there's a lot to notice here. Look at the amount of volume that we had during the corrections. After we turned up from this low, the biggest down volume is right here. I think, is that 2 or 7? It's 7. And this is 7. And this is 1. And then suddenly we have 900 contracts. That's a subtle change in behavior. It's nothing overt. And then the market makes a new high. And what do we notice about this new high? We don't make much upward progress, do we? And we have a lot of volume. We have 2,100 contracts. Now, is that something that stands out, the 2,100 contracts? That's the heaviest volume on an upwave on this chart. And yet, for all of that effort, the market made very little upward progress. So we have a clue here that the market is encountering selling. Otherwise, with all of that effort, we would have made further progress. And then we have another change in behavior. The market sells off on 1,400 contracts. Since the market turned up from the 4:15 a.m. low, where we had 1,500 contracts, this is the heaviest amount of down volume since that time. As I said yesterday, working with the Weiss wave involves a pullback method. I watch for a change in behavior. I've had two. First, there's been a large effort to go up with no reward and climactic volume. And then we have a sell-off with the most amount of down volume since 4:15 in the morning. So I know that people were selling on the rally with 2,100, and now I see evidence that they were selling again on the breakdown to 1,400. But the market holds and it rallies, and the volume on this rally is a mere 700. That doesn't look like aggressive buying. And the market comes back down, and the volume is relatively small, suggesting that there may be another attempt to go up. So watch what happens. It's not moving along here. I got it. I'm not good with machinery at all. Thank you. Thanks, Steve. All right, so now you see the result of the next rally. Is this a strong demand rally? Is the force of the buying overcoming the force of the selling? No. We have a lower high now, and the volume on this upwave is a mere 400 contracts. What now? Yeah. Right here. You can see the volume right down here. Absolutely. I'm ending each frame of this at the end of a wave. We're not going to do it tick by tick. The volume, the last wave had lower volume. All right. And now the market breaks. Do we have supply? Is the force of the selling overcome the force of the buying? Indeed. Now we have 1,600 contracts. There's little doubt of what's going on now. All right, watch. Is this a strong rally? It's minimal. I would have thought that the rally could come back and test these lows here, which we broke through on this downwave. We couldn't even get back to that previous support that should have been resistance. Instead, it was very anemic, suggesting that the trend is still down. All right. Now we go down again on 1,600 contracts. Lots of selling. Although this time we don't make quite as much downward progress as we did on the first 1,600. But I don't see anything that's bullish. If I were short, I would lower my stop to just above the last pivot. All right, now watch. And we have another robust rally on almost no volume. Very shallow. It still says the trend is down. All right. And now we go down again on 800 contracts. What do we see here? What stands out here? Right. This is not just low volume down. It is the lowest down volume since we had this high earlier in the day, earlier in the morning, right? So suddenly the force of the selling is diminishing. And we get some insight here that the market might be reaching towards a low. So we might just lower our stop to the next pivot, a little bit above it. All right. The market now rallies. Actually, it had a small rally in here, and then it goes down one more time. And notice how much selling pressure there was. Very low, yes. What's that?
In real time, could you just repeat this as well?
Yeah.
In real time, when does it print those numbers after the bar's closed?
The numbers are printed on the chart after the wave ends. But the volume down below is building during the wave. And of course, you can always just left click and read the data. And if it's in the current wave, it shows the volume right over here in the margin. Sure. All right, so now we've had another change in behavior. This is the biggest rally that we've had since we turned down from the last test up here on 700, and it's the heaviest amount of up volume since the market had turned down from the 21. So there's a change in behavior. Evidently, I skipped a frame, but anyway, you see the next pullback is only on 300 contracts. What does that say about the force of the selling? There is no selling. There's just no selling pressure there whatsoever. If you didn't get stopped out, you better get out. If you're not short, or if you're flat, you might want to go long. I don't show any more on this, but from here, the next up wave goes up into here. There's a small pullback, and then there's a new high on the day. All right. Let's go on. But this is how it works every day. I come in and I sit and I wait, waiting to see something that I understand, waiting for the trade to bring itself to me without forcing it. I like to find it, like walking down the street and finding a $20 bill on the sidewalk. We all pick those up. Okay, here's another chart. You can tell by the price that it's probably gold. What do you see here? Anyone want to venture? Anyone on the web want to venture an opinion of what's going on this chart? Gavin, is anyone responding to my... It did hit this resistance. But look, we had very large volume on these two down waves. The market tries to rally, and on the next down wave, look at the force of the selling. You see how small it is. That's telling us that the selling pressure is drying up.
That's what people are saying on most people's
I see. Most people on the web are recognizing these things. That's good. And from there, we get a rally up into a natural resistance barrier. But look at the amount of demand that comes in on that rally, and look at the ease of movement on this rally. This is a very strong rally. It's the second largest rally on the chart. This was the largest one over here. All right, so we had good demand. Now, looking at this down wave, what do we say about the force of the selling? Is it great? Not at all. You see how the market is pulled back? There's no supply. Well, the only way you know is because I set it up that this is the end of it. Well, you know, I have to present charts. Yeah, it's all right. I have to present charts that typify the behavior. I mean, I could present lots of charts that would be very difficult to figure out.
David, Tom Williams once said to me, let me just
all right. Here's Gavin.
So Tom Williams, the question was there. It's an excellent question. When do you know? Well, interestingly enough, when a VSA signal appears live, and I go and show charts in hindsight and say, well, look, that's end of the rising market, that's no demand. Tom will say, well, don't be concerned, Gavin, that you're showing hindsight. He said, because if it was there in hindsight, it must have appeared at the time, which is true.
That's right.
He said, but you'll miss it because as a trader, your emotions will be looking at things, and unless you control your emotions and say, that is definitely the principle, and believe it, you won't take the trade. So these things you're seeing now, you won't be there every minute of the day or every day of the week, but well, you actually will see a lot of it, actually. But when you do see it now, because you've been taught to see it, you'll recognize it. And you're right, you could easily cherry-pick charts, which you have to do when you're doing education, and say, well, that's a really good example. But you'll find, and I promise you, that you will, in the next 2 or 3 weeks, see the end of a rising market or bag holding on something, and you'll immediately recognize it because now you know it. And the same with the wave count here. You'll say, that is a bullish change of behavior and is a bag holding signal. Should I go long there? And then your decision-making takes over.
All right. Thank you, Gavin. All right. One way you know when it's over is when you have a reversal. In other words, the wave size on this chart, the minimum wave is 0.50, half a dollar for gold. So whenever there is a closing price, I don't remember if this is 3 minutes or 5 minutes. Maybe we can tell by the date line, or maybe it's a tick bar chart. It'll show on the next frame. But anyway, as soon as you have a close, it's a half a dollar, 50 points, above the close here, then you know that this wave ended. You see? And of course, the real art to this is that after a while, you learn to anticipate that. But you can't do that right off. You have to have experience working with it. Well, watch. Okay. This is a tick bar chart, 100 tick bar chart. It really works well on gold, I remember now. So you see, the selling dried up, the market turned up right about here and lets you know that this wave had ended, and up we went. And this is all within 1 day. It's not that big a move for gold. All right, and I drew those horizontal lines to confuse you because we draw those lines as resistance, but we still have to deal with the price volume behavior first and foremost. All right, let's go on. Here's another one. This is July corn. This is another tick bar chart, 300 tick bar chart. And you see the market has been going up for some time during this day. A beautiful rally. Does anyone see anything that is a warning sign that this rally might be in trouble? No up volume, correct. The volumes on the up waves, here's the first big one, right here. Then the second big one is right here. And then look at them. This one has this much volume, and the last one has only this much volume. So the force of the buying is diminishing, right? And then on this last down wave, look how the volume is increasing. All right. Now look. Now I've drawn the lines, which I'm always drawing. I keep drawing lines across highs all the way up. You see a classic example of shortening of the upward thrust. This is a normal trend line. This is a reverse trend line drawn across highs. And there's the down volume. And after this down volume that ends right here, oops, how do I go backwards? After that down volume, look at the character of the rally. Look how much demand comes in on that rally. I mean, this is like a child playing with blocks, and he builds it up taller and taller and taller, and all you have to do is just touch it with your little finger, and it all falls down. Well, this is exactly the same. It just all falls down. And the selling pressure is the dominant force all through the rest of the day here, or at least on this portion of it. All right. All right, this is a chart of soybeans. This is another tick bar chart, 100 tick bar. What do we see? What stands out on this chart? Anyone venture to say? The bears are taking over. Well, I think that is pretty evident. The obvious clue is that we see supply on this downwave. What about the character of the buying on the last upwave here? It's gotten weaker. We had a lot of demand here, and then on the last push, which is just this part of it, you see how the volume just about dried up. And there's another factor on this chart that's a bearish component of it, and that is if you draw a horizontal line across this high to the right, you see that this is a potential upthrust of that high. I always tell people you can make a living trading springs and upthrusts. If you know nothing else, just recognizing a spring or an upthrust. Here was a spring right down here. Draw the lines and they'll come out, pop out on the chart. Here's a level of support. Draw the line. You see how the market goes under it. Look at all of the selling that came in on this downwave. And yet all of that effort produced very little follow-through. And then you had this nice swing up, and you have a potential upthrust. And so here's the end result. Here's where we were. I've drawn the line now. And here's that last week rally with no demand. And then see how much supply continued. This is a continuation of the wave that we saw earlier. And there is a fairly decent attempt to go up, but it's probably less than 50%, and the selling just dominates the chart. You see? All right. Anyone have any questions about this chart in here? What? When do we get out? Good question. What we do here is if we're short, we keep lowering our buy stop above each pivot. And then if we start to see something like shortening of the thrust, or see the selling pressure drying up, or very heavy selling pressure with little reward for the effort, those are the kind of things that we look for to cover the short. You understand? Sir. Right. Right. Yes, Jack has mentioned how the sellers are dominant throughout this whole decline, and that right here even we still don't see any demand. But we do notice that on this last piece of a wave, we don't know, I don't have the rest of the chart on here, but on this last portion of a wave, there is no supply. And so far, all right, some questions from the web. Why not? Yes, the question is, would you take the short after seeing the massive supply on this downwave? I see no reason not to. You might wait and let the market turn back down. You can see that there's no demand here. Not at all. You can hardly see the green volume. And I think that this might be a minor upthrust of this little high. But when it reverses down, it's a no-brainer. Get short, put your stop just above there, and let the black cat hop. All right.
Is there anything you have to filter when the market is non-trending?
The question is, do I have any kind of filter when the market is non-trending? When it's non-trending, I try to leave it alone. When it's chopping up and down in a range, I wait for something that's clearer. I don't want to force a trade. Anything else?
It's more of a comment, but I turn it into a question. One thing concerning about using obvious pivots for stops is will the smart money or composite operators target these areas?
Someone wants to know if the composite operator or the smart money will go for stops above previous pivots. They may. I don't know. I can't guarantee anything. But I've got to lock in profit and protect myself. So that's all I can do. Any other things?
Is it typical for the large volume reversal wave to make little progress because it's going against the current trend, or it's like the stopping force for the current trend?
The question is a little involved, but someone's asking if the, what was it again?
It's for the first large volume reversal wave to make little progress.
Oh. Yeah, in other words, if you have a large volume wave and you don't make much progress, you have to be alert to the fact that it could be a lot of effort and not much result, and that things are not going to turn out, in this case, of going lower. You always have to, evaluate everything as the market unfolds. But effort versus result is a very good thing to keep in your mind when you're reading the chart. All right. Okay, this is a daily chart of the sterling yen. It's a cross rate that I think is a very good trading vehicle because of its volatility. And the question, of course, is, this is a little more difficult. We can see a few things here that stand out. Obviously, on this down wave right here, there was some selling. You see how much we had there. And then here again, sort of like what someone just asked, there's a lot of effort to go up. And despite all that effort, it stops. The market reacts and it tries to go up again, and this time there's much less demand, and the market starts down with increased selling pressure. And the end result is right here. A very nice downwave. But this is working with daily data. It's a different speed of trading.
Was that a tick chart?
No, that was a daily bar chart. I use tick bar charts, and I use time-based charts also. All right, this is a chart of crude oil. And this is made from 5-minute data. And on this chart, I plotted the minutes per wave along with the volume per wave. There's a good correlation between time and volume. Remember, Wyckoff said in his tape reading course, the way you can tell when a change in trend intraday is taking place, in the case of an up wave, when the down waves begin to increase in time and volume and distance. Anyway, you see we're going up, and let me find the cursor. The market is pressing its way higher with a great deal of volume. Where would you draw an important horizontal line on this chart? A line that helps define what's going on here. Anyone want to venture an opinion? Well, right here, this previous high. You notice that when we broke from that high, we had a lot of selling pressure. The most amount of selling on this chart. So I would draw automatically a horizontal line across here. And you see that the market is trying to absorb its way through this high from which we had all of this selling pressure. And as it's going up, it's not going up with great alacrity. We don't see ease of upward movement. It's a struggle. I look at this like a weaving, like the texture of stitches. It's very tight. It's not loose and goosey. It's not moving like a stallion running across the plain. It's much more difficult rally. And here on the last wave, we have all of this volume, and yet we're not making much progress. Now, that would certainly alert me that anything that starts to turn it down, any supply that comes in, I'm going to jump on it. And of course, as you've already seen, on the next down wave, you see that we do get supply. We break underneath this level of support. We have a lot more downtime. This is the heaviest down volume since over here. And then we have a very anemic rally right here with no demand. And then the market just falls apart. And the volume soars, and it lasts a long time. The sellers just keep feeding on the market. All right, any questions about this chart from the web or anywhere else? Repeat the statement that Wyckoff made? Well, I'm just paraphrasing it. I don't have the quote in front of me. But he said the way to recognize when the market is changing direction intraday is if the buying waves begin to shorten in duration, volume, and length, and the selling waves begin to increase in duration, volume, and length, that's a sign that the sellers are gaining the upper hand.
There's a question, David.
Yes.
From Nathan says, what is minutes per wave? How do you read it? Can you just repeat that? So can you explain the minutes per wave?
The question is, what is minutes per wave? Well, all I can say is it's the amount of time that elapsed on each wave, up and down. It's that simple.
Do you count the individual bars, or is each wave taken in totality?
This is a 5-minute chart. And so if there are 6 bars in a wave, then the duration will be 30 minutes. Now, if I was doing this with tick bar, you couldn't just say that right out. If there's 6 bars, it's 30 minutes, because each bar might have a different time. Why are some of these bars taller? Well, this is such a long duration on this decline that the amount of minutes, I mean, you look at the scale. You see? I mean, we have, prior to this wave, the amount of time was not too big per wave, but here, how many 5-minute bars are there in this decline? Well, I mean, it looks like there could be 15 or more. So if there are 15, then that's 75 minutes. Pardon me? Yeah, maybe an hour and a half. I couldn't hear you. It adjusts, right. It adjusts to the length of each separate wave. The duration, rather. Okay. Okay, I said on one of our webinars recently that I wanted to show something I've never shown publicly, and that is Renko charts. I'm sure everyone has looked at Renko charts.
Well, let me just ask. Can you ask the audience how many people are familiar with Renko charts?
All right, how many people are familiar with Renko charts? All right.
So you assume that everyone's familiar with them. I just started using them. So very good.
Anyway.
No, everyone said no. No one knows what Renko is.
Well, on TradeStation platform, we have a choice of different kind of charts. We can make a point and figure or a line chart or intraday bar chart or whatever. And one of the choices is Renko. And I had never heard of it either.
We have it in TradeGuider as well.
You do?
No one ever knows if it's there.
Gavin says it's in TradeGuider too. And I just started playing with it. And the way it works, it consists of bricks. And when you read about the classical interpretation of Renko bars, they always say that it does not involve time and it does not involve volume. It's just pure price. And so in this case, I'm showing a wave, a brick, say a stock, and I'm declaring that the brick size is 10 cents. And I'm assuming the market is going up. So as soon as it hits this level, which is 10 cents above the low here, then it prints this brick. And then it starts waiting to form a new brick. And the formation of that brick can occur in 2 minutes or 2 hours. There's no way of knowing. And imagine this. There's a high. This high was at $11. It could go as high as $11.09 and not form a brick. And it could go as low as $10.81 and not form a down brick. So you've got a range here from $11.09 to $10.81, 28 cents or whatever it is, and however long it takes.
Question, David.
Yes.
Tom is asking, it sounds like Renko is exactly the same as a range bar chart.
It's very similar to a range bar chart. Okay. All right. But I want to show you what I discovered. This is a Renko chart right here. And I put a wave line on top of it. The Weiss wave works right on top of it nicely. This is a chart of gold, and every brick is $1. Is that right? No. Yeah, $1.1. And right here is the wave volume the volume per wave. I treat these as individual waves. And this is the volume per brick. And this is the duration of each wave. Or maybe it's each brick. Yeah, it's the duration of each brick. So suddenly, because of computers, I do have volume and I do have time. And I think this is an incredible tape reading tool. It takes some getting used to, but look at how the buying comes in. You see you had a spring here, The market is taking out these lows, and then it starts to turn up. And you've got some pretty good volume on these individual bricks. And then look at the wave volume on this move from this low to this high. Again, it's a big increase in up volume. And then look at these down waves. They're only one brick. Now, some of those bricks, like this one, span some time. I can't read it now, but 19. So 19 minutes right here. And there's a pretty good amount of volume. That's the heaviest amount of volume on a down brick up to that point. And for all that effort, it doesn't go lower. And then it starts up again. Until finally over here, you start seeing supply. And I don't have other charts exemplifying this, but I've experimented with it, and I find it very, it can be very useful. And one of the nice features about Renko is that you see you don't see all of the corrective moves. Like in this wave right here that's 19 minutes down, how many bars are in that area on a 3-minute chart? Well, it might be all kinds of movement, but it's filtered out. This is a great filter. Like a point and figure is a big filter. But unlike a point and figure, which just shows a plot of an X and an O, here we can tell how much volume occurred at each plot and how much time was there. Some of these bricks occurred in the same minute when it was moving fast, and then others might be very slow. And it can help you stay in the market much longer than if you're looking at all of these individual bars and seeing the mirage of this looks bullish, this looks bearish. It filters all of that out. So I just introduce it as something that I think is worth studying. Right.
And then it stalls off, it has a little reaction, and we still get a lot of buying pressure, but not as much.
Yeah. So someone's noted that the buying pressure is diminishing on this last upwave. It's not over till we see supply. Yeah, someone said here that you see all this selling pressure and you would look for a correction to try to get short. Well, perhaps so, but you don't know what's going to happen just yet on how far down we're going to go and where the next upwave is going to peak. But I would think that this is a bearish change in behavior here. Yes. Right. That's right. Someone has mentioned the difference between the range bar and the Renko chart. And the Renko chart can be on either side. I mean the range bar chart. And the Renko will stay in the direction. Yeah. You won't have them moving next to one another. It's always either going up or going down. There's no contiguous nature to it.
Sorry, cool. It also seems as if you're entering a trade off of a Renko chart. You need something else to tell you where to put your buying order, or place your initial order, your opening order. You need a dome or something.
Well, sure. Someone's mentioned you need something to help you get in using this chart, enter a trade. And you have to, this is particularly suited for a momentum trader because this Renko chart embodies momentum in it.
David, there's quite a few questions coming in there. If you could repeat these to the audience as well. Brian says range bars build equal blocks of price, but they don't have to build on top of each other. They can start in the middle of the previous bar's range.
Right.
Renko has to build on top of each other. So if you could just explain that to the audience.
Well, as someone has just commented, range bars do not have to build on top of one another. They can move on either side of the previous range, whereas on Renko, it's always on top of or in a downtrend below the previous.
Yeah. Keith asked, what is the first lower indicator representing? The first lower indicator.
The first indicator right here, what is this indicating?
I think so, yeah. And also the one below it.
I'll go over it again. This is the amount of volume per brick, and this is the amount of volume per wave. I'm treating these as waves. And then down here is the amount of time or minutes per wave.
Gotcha. Okay, can you just ask the audience here if they totally understood what you just said?
Does everybody understand what I've shown here?
Just repeat it just for the sake of repetition.
All right, again, this is the volume per brick, and this is the volume per wave, and this is the duration of each brick right here, the time elapsed in each one of these little bricks. And so you can see here, as the market is moving up, it's spending a lot of time in these first 3 bricks off this low as the buyers are absorbing through the sellers.
Yeah.
That's what's taking place.
Steve's asking, if you're long there, at what point in the chart at the top there would you consider exiting a long trade?
All right, the question is, where would you get out of a long trade? Well, the first thing I would do is draw the channel and see where we are if we've gotten overbought. And then, as soon as I start seeing supply, I would get out. You don't have as many pivots on these charts sometimes. That's the only thing I know.
Okay, that's good. That's all the questions.
Any other questions? Well, Gavin, if you can bring up the other slides.
Sure can. Yeah, let's go this side. It'll be easy. Let's go down.
Oh, thank you. It's your language, you understand all this. Isn't that Canadian dollar interesting, that chart?
Okay, so this should be that, your first one, US.
No. That's what I did yesterday.
Oh, okay. Let's go past that then. Okay, just bear with me. Okay. Let's just find out where it is. It's easier doing it this way.
Here.
There it is.
Okay, that's it.
Okay, so if everyone wants to find Weiss wave trade setups, that's the next thing David's going to cover. Good.
Thank you.
By the way, while we're setting that up, if you want to hear the funniest story ever, this is it. The gentleman that just came in and spoke to Richard, my business partner, who looked all upset and flustered, and I thought there was going to be some trouble, which is why, as an ex-policeman, I immediately went over. Turns out to be a Chicago cab driver. Now, this is true.
Oh, no.
And he said to Richard, sir, have you left anything in the taxi? And Richard, absolutely not. He said 6 passengers he's been driving around to return an iPad. So I said, Richard, check. Richard opened his case. There was no iPad. The cab driver had it.
Oh, praise God.
Praise the Lord. True story.
And it was
an
the same.
omen.
And it was the same cab driver who
No,
brought
well,
us in here this morning.
that would have freaked me out. No, that's a good story.
If it was New York, they'd be running.
I know. They'd already have it sold. All right. Well, this is a file that I put together and I've added to over the months, illustrating some of the setups that I look for. And most of these at the beginning use a 4,000 tick bar chart. The price movement is removed. The price movement is removed and just the wave line is present. And let's go right here. Now I'm going to try to read this. All of these charts at the beginning are of the S&P E-mini. And I'm just trying to show the concepts that I look for on a chart that I've shown you on real charts. Now, this is a real chart too, but this is more abstract. The bars are removed. And you see on this chart that what you do is you're looking for a change in behavior. And I mean, there are several changes in behavior here. I mean, I can see that the distance from this high to this high to this high is shortening of the thrust. But in terms of working with the wave chart, the information, the change in behavior is right here. You see how much selling pressure comes in. So when that occurs, then I'm going to watch the character of the next rally. And if the volume diminishes, then I have an opportunity to put on a short with a stop just above the high of the last downwave to see how it will work. This is basic to what I'm doing. Remember again what Wyckoff said. How do you know when a swing intraday is coming to an end? When suddenly the length and the duration and the volume on the down waves exceeds that we've seen on the up waves. You follow me? There it is. All of this stems from Wyckoff's words. All right, let's see what's next. All right, here's another example. You can see here that the market has a very large upwave. It sells off here. And then notice how the volume is diminishing. That's another thing I look for. When I see that, then I'm alert to the potential of a short trade. If anybody on the web has a question, just let me know. All right. On this one, the change in behavior, I think it's right here, right? I can't see the numbers too well because of my... Yeah, it's 44,000. That's the heaviest down volume on the chart. That's a bearish change in behavior, or it's pretty close to the heaviest. And then look at the volume on the up wave. It's much less. And so we have a succession of lower highs and lower lows. Okay, over here, we have some supply coming in here, and look at the rally. There's not much demand on that rally, and then down she goes. You know, this is not trying to make a home run every day, just trying to carve out average profit per day, or as much as you can make per day, however you want to do it. All right, this is one of my favorites. Here's a change in behavior on the upside. The market's been coming down, and here you go down on very, very heavy volume. It is climactic. And then look at the volume on the first up wave. That is an overtly bullish change in behavior. So much buying came in there. Obviously, a lot of it is short covering. But this is a sign that the market's going to go up. And then on the pullback, look how much selling pressure comes in. Very small amount of selling pressure. So when you see that, then you can go long either above this high or as it reverses up, however you want to play it, and put a stop just under here. And as it moves up a little more, jam your stop up underneath here. So we're buying at a spot where the risk, we're trying to to enter the market with very little risk. I often used to tell people that what I do for a living is describe risk. If you go to a lawyer and you want to have a business entity with another person, you can have an LLC or you can have a joint partnership. The deal is to provide the most amount of safety, no liability. That's what the lawyer is going to try to arrange for you. If you go to a doctor and the doctor tells you you've got a tumor in the middle of your head, and it's up to him to decide the course of action. We can start with cobalt, or we can cut your head open. What's the least amount of risk for you at your age and your state of health, and on and on and on. And if you come to me or someone who's steeped in the markets like this, I'm trying to find a method that will provide you the least amount of risk in entering trades and the highest probability of success. All right? Same story, right? Here we have the heaviest down volume on the chart. And then look at the rally. Much lower. Now, you know, I guess we'd love to have everything be classically apparent. This is pretty apparent to me. Any questions from the web on these?
After the significant change in behaviour followed by a weak retracement, where exactly would you enter a trade? Immediately when it reverses from the retracement, or would you wait a bit?
All right. The question is that when you get the change in behavior and you have the pullback, either up or down, where do you enter the trade? On the first reversal? That's certainly a reasonable place to do it. Or you could use a trade where you enter if it takes out the previous low, like right here. You might say, if the market breaks this low after this low volume rally and this high volume bearish change in behavior, then I want to get short and put my stop right above there. So there's several ways to skin the cat. All right. Well, I can't see the numbers too well, but you can see in here that you have a bullish change in behavior right here. You see how much demand comes in there? And then you have a series of corrective swings, and the ray volume is diminishing greatly. That's a good sign that the market wants to go higher. Here's another situation. Here's the bearish change in behavior. You see, I drew a normal trend channel from here across here with a parallel line. We came to the top of the channel. The volume was still good, but it's the selling pressure on this downwave that tells you the wind has changed. The force of the selling has overcome the force of the buying. It's time to get aboard. And you know, sometimes you have this bearish change in behavior and you get almost no rally, and then you have to risk more money. That's just how it is. We don't know. All right. Let's just go on past that one. All right, here's another one.
Can you see the cursor? Everyone said people say they can't see the pointer. Can you just make sure the pointer's there?
Yeah, here's a pointer.
Here it is. Yeah, good.
It's just dancing around like a little gnat. All right. Up here, you see, the market's been going up, and on this rally, See how the volume diminishes on that last upwave. And then you get some supply. And then look at the quality of the buying. It's not too great. And this is also a shortening of the thrust. That's the next trade setup. Besides the pullback, well, it's one of the other trade setups, is I'm also watching for shortening of the thrust. And you'll see some examples of that in here as well. How much time do we have left?
About 25 minutes. You're good.
All right. All right, here's some examples on one day in the life of silver trading. Examples of small shortening of the thrust. They could also be called springs and upthrusts for that matter. And there are several ways shortening of the thrust can occur. Like right here, the market makes a new low, just barely, and there's no supply. And then it rallies vigorously. Over here, there's a low, and we break that low, and look at the large effort and no reward. And when it turns up, that's a good place to get long. Up here at the top, we have shortening of the thrust, and the up volume on the last upwave is very small. Down here, I'm not really sure we could call that shortening of the thrust, but anyway, notice the little axis line I've drawn here. Across this high, where we absorbed in here and then pulled back on top of, broke through, and when we broke through that line, look how much supply came in. And now we've rallied back to test this breakdown, and look at the force of the buying. It's nil. And then lastly, over here, again, we have a change in behavior right here with a lot of demand coming in, at least for the moment. Anyway, I have more examples of these, but shortening of the thrust is a main part of my strategy for finding trades. Well, this is just describing about shortening of the thrust and some things that I have to say about it, which you can read. Now, here's some more of it. Here's an upwave. The market goes from here to here, to here, to here. And you see the last upwave has very small volume. Then again, you see an upwave from here to this high, to this high. And again, the up volume is very low. Over here we have a little spring. Notice that the selling right here is extremely low, and so on. Up here, there's no demand on this last little upwave here where we have shortening of the thrust. So these trades pop out intraday all the time. Okay, this is another little trick that I've done from time to time. And here I have two wave lines of different size. Let's see. The red line, hold on. The red line is, can you read it? I can't read it. What is it? The red line is what?
47K 10 minutes, it says.
Oh, no, yeah, I know. All right, that's not what I meant.
Okay.
Do I say the red line is the 75-cent wave?
Oh, 75-point wave black, and the 25-point wave is red. It's 25
okay. I've got two waves. A 25-point wave, which is red, and then I have a black wave, which is 0.75. So two waves. Sometimes they are the same. When you see the red, the black on top of the red or whatever, it hides the other one because they move together. All right. The volumes on the black wave are written on the chart. And this is the volume on the 25-point wave down here. And sometimes you can get an edge by looking at this. You see you have a big up wave right here. 0.75. You don't see any detail in there. It's just all one wave with a lot of volume. But if you're looking at the 0.25, you can see how much demand came in on the very first little upwave right here. You see, I wrote down that volume number. I can't see it. What is it? This volume number right here. What? 47,000? Yeah, 47,000 here. And then the pullback is just a fraction of that. All of this information is given to you by the 0.25 wave within the context of this larger 0.75 wave. I don't do this all the time, but I found it could be useful. So I incorporated in here just showing some of the things that you can do. All right, let's see. All right, this is an example of a tick bar chart again. And you can see, as I've outlined here, first of all, the drying up of the volume up here, and then the supply that came in on this downwave, and then the very weak volumes on these little pushes up here, and then a lot of supply here. And look at the horizontal line, how we come up underneath it, and down she goes, dominated by selling pressure. It's a beautiful chart. So this is the S&P. All right, let me see if I've got this right. Yep. And this is an example of gold, a 20-cent wave, using 2-minute closes. And I asked the question here, I probably showed this at one of the webinars, but what is the best trading signal on this chart? The answer is on the next page. But looking at this here in the room, how many of you can see what tells you this market is going to move down? Anyone want to venture an opinion? Of course, you've all looked, I guess. Are you referring to this push? Yeah, but that's already after the move has begun, well underway. I'm saying what up here told you that we were going to turn down? The what? Yeah, look how much selling came in here, and then look how little demand appeared here.
Yeah, most of the people who went picked that up as well.
Good. Yeah, but anyway, I'm most interested in how much supply appeared on this wave. That's the bearish change in behavior. And then here's the low volume pullback, the pullback method. All right, this is a chart of gold again. And, oh, it's the same chart. And you see what happened that day. And there was another opportunity over here. I didn't discuss it. But demand tired out up here as well. And we got the last leg of the break. Okay? I know I've shown this to the trade guide of people before. This is Apple. Is there a change in behavior on this chart that indicated the market was going to go down? This is hourly data, if I remember correctly. It's a 10-cent wave. Imagine, we're looking at a very high-priced stock, and I'm still using a 10-cent wave. But where's the bearish change in behavior that said that we were going to go down? Anybody recognize it? Yeah, right here. Biggest down volume on the chart. You mean getting less and less on the upside. Right. That's a sign that demand is tiring. And then you get the supply. I mean, what a nice trade this was.